Okay, so in today's video, I want us to talk about liquidity and the different types of liquidities we have because I know a lot of people struggle with this topic. So let's go straight into it. So the type of liquidities I use is, firstly, we have previous session highs, which let me just turn this indicator that shows the sessions. We have previous session highs and lows. Like we have Asia high right here, Asia low, London high, London low. So if you look here during the London session, we took out the Asia high, and then during the New York session, we came back down for both the London and the Asia lows. So this type of, let me go down to 1 minute. Whenever I'm looking for opportunities and I don't have like higher time frame highs or lows, I usually just target the London and previous session highs or lows. So if you look here, right after the London session, we had this London high that's got swept, and then we had a reversal back down, taking out the London lows and the Asia lows. And then another type of liquidity we have is where we have a level of support or resistance. Now, what I want you to think when you think about this is, where would support and resistance people be taking their trades? Whenever we have a price like this, hold on. Whenever we have a structure like this, you should think to yourself, where could the support and resistance people probably be taking trades right now? Obviously, there is a resistance level right here, so they are probably taking sales right here. So then you know that, okay, they have their stop losses above here, because that's what liquidity is, the pool of money or resting orders, right? So what the market makers do is that they keep price in a tight range to create liquidity on both the upper and the lower part of this range, because they know that retail traders will be taking sells here and they will be taking buys here. So in order for them to be able to take price higher, they will have to do what? They will have to take out the stop losses of the people who are selling here first, and then that's also inducing the sellers here with this move lower, thinking they are in profits, and then it just goes back and takes them out. Let me turn this on. So we have a basic example like that right here. I saw a nice example of that right here. During the London session on Friday, we have this level here, this whole space here. So market makers keep price in what? The tight range. All you do is think to yourself, okay, support and resistance people are probably taking sells here. You have a couple of fair value gaps in here. I wouldn't be taking trades in that, because why? I think to myself, okay, what are support and resistance people thinking right now? They are taking sells. Every time it touches this level, they are taking sells. So there are a lot of stop losses above here. There's a pool of liquidity above this level here, which market makers are probably going to take out if they want to take price lower. So what happens? We take that out and then we reverse lower, targeting the previous session lows, and then also rebalancing price. So another type of liquidity that we have is basic highs or lows, like previous swing highs or swing lows, just like this high right here. So we had a pullback and then left this high here. That's also used as liquidity. Right now, in this case, it was used as a previous day high because it only got taken like the next day. So it was marked as a previous day high, just like this one. It's Friday's high. We're also gonna use that as liquidity if we expect price to go back higher. So all you do, think to yourself, where are the support and resistance people placing their trades right now? Because wherever that is, they're always gonna be stop losses at that level, and we are most likely to take that out. Now we have also levels like this, equal lows or equal highs. ICT calls these like smooth lows. So these type of lows is, you guys know, those who've traded support and resistance, you know, double tops and double bottoms. These, you use these as confluences for your trades. So there's probably people who took buys here and see how it induced those buyers. It continued pushing higher, so they are in profit. Now they are busy trailing their stop losses, and then what happens? It takes them out. It's probably still also gonna take this out. So equal lows, equal highs, previous session lows, previous session highs, or previous swing highs or swing lows. And we also have trendline liquidity and low resistance liquidity, which low resistance liquidity is basically where we have, let me have something like this, where we basically have a level like this, and then maybe we come and tap into that, and then we just keep creating low high, and not actually sweeping these lows here. So then always, whenever we have maybe a fair value gap or something here that, or we need to rebalance price, I know we're gonna sweep these lows here. I know that this level here, that's liquidity. We're definitely gonna take that, and then come into this and then continue higher. And then in here, that's where I would look for my SMTs or my inverse fair value gaps. So liquidity is a very simple concept, just that you have to, know what type of liquidities you are looking for. Those are all the liquidities that I use. That was previous session highs and lows. As you see here, we took the previous, the London session low and the London, Asia session high, low. And then we have support and resistance levels where they would be taking their setups. As soon as we have a level like this and it takes out the stop losses of the sellers, it retests, right? Now they are looking at us thinking we're gonna push higher. Whole time it was just taking out the stop losses here, because in order for the market makers to be able to take their buy positions, they need sellers. And when they wanna take sells, they need buyers. They need people buying. So because they trade with large positions, with large amounts of money, if there's not enough liquidity or they just take a trade anyway, it would cause like major spikes or random impulsive movements, or their entries, their positions can only be filled. Maybe if they wanted to take sells in here, their position would have only been entered maybe somewhere down here if there's enough liquidity. So they have to make price, they have to manipulate price in order for it to create liquidity, so that retail traders can take entries opposite the direction that they want to go. So here, if they know that they want to take sells, they're going to manipulate price to make retail traders buy, which is why they didn't just move price lower right from here, because they know that there's people who are in sales and there's liquidity here which they can use. So as soon as you take that out, there's people out of the market and getting in the market with the opposite direction. We have people buying, now they can enter their sell positions. They have enough liquidity available in the market for them to be able to take their sells. I hope you guys understand. If you have any questions, let me know in the comment section and I will explain more on it. So yeah, I'll see you guys in the next one.